Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money world without sounding like robots after a data dump. Speaking of data dumps, today we're diving into Synchrony Financial's massive 10K filing for 2025. Get ready because this one is a doozy full of numbers that tell a wild story, and some risks that will make you rethink your credit card. Before we dive in, if you love getting these insights without the corporate jargon, make sure you are subscribed. And hey, we've got a growing community on Discord where we break down these filings even further, so check that link in the description. Alright, Synchrony Financial, you know them as the company behind a lot of store credit cards and other financing you see everywhere. They've just dropped their annual report, and it is a deep dive into how they did in 2025. Let's start with the headline number everyone cares about. Net earnings in 2025, Synchrony raked in $3.6 billion. That is a 1.5% jump from 2024. Sounds good, right? But what drove that increase? Well, a big reason was a significant drop in the money they set aside for expected loan losses, down by $1.5 billion. Think of it as them needing to cover fewer bad debts than the year before. Their net interest income, which is basically the money they make from loan interest, minus what they pay on deposits and borrowings, also grew by $455 million. This was mainly because they paid less in interest on their funding, but on the flip side, they had way less other income compared to 2024. Why? Because in 2024, they sold off a pet insurance business called Pets Best, which gave them a massive $1.1 billion boost. So when you take that one-off gain out of 2024, things look a bit more stable for 2025's earnings. Now, about those loans at the end of 2025, their total loan receivables, the money customers owe them, stood at $103.8 billion. That is a slight dip of 0.9% from the year before. They say this is because customers are paying down their balances faster, a sign of a healthier credit mix, and also because their purchase volume, meaning how much people charged on their cards, was flat. This indicates they might be being a bit more careful about who they lend to, which can be a double-edged sword good for reducing risk, but potentially slowing down growth. And speaking of risk, how are those loans looking in terms of customers actually paying them back? Their over negative 30-day loan delinquencies, meaning how many loans are late, actually improved. They dropped to 4.49% of all loans outstanding at the end of 2025, down from 4.70% in 2024. That is a good sign, suggesting customers are generally in better shape financially. The net charge-off rate, which is the actual amount of money they wrote off as uncollectible, also went down, falling 66 basis points to 5.65%. This means they're losing less money on bad debts, which directly helps their bottom line. Their allowance for credit losses, the money they've set aside for potential future losses, also decreased slightly to 10.06% of their total loans. Where does Synchrony get all the money to lend out? A huge chunk comes from deposits. At the end of 2025, they had $81.1 billion in deposits, making up 84% of their total funding. That is a slight decrease from 2024, but it shows their banking arm, Synchrony Bank, is still a major source of stable. Low-cost funding. This is super important because having your own deposits means you are less reliant on more expensive market funding, especially when times get tough. Let's peek at how their different business areas are doing. The home and auto platform, which includes things like furniture and car financing, accounted for 26% of their total interest and fees on loans. They have some really old, strong relationships here, like with Lowe's going back 46 years. This long-term stability in major partner accounts is a big strength. Then there is the digital platform covering online marketplaces and digital-first brands. This is a huge part of their business, accounting for 30% of their interest and fees. Think Amazon and PayPal here, with partnerships going back over 20 years. This suggests they're doing something right to keep these digital giants happy and engaged. A huge part of Synchrony's strategy and a key risk is their reliance on these partner agreements. Their 5 biggest partners, Amazon, Lowe's, PayPal, Sam's Club, and TJX companies brought in a massive 54% of their total interest and fees on loans in 2025. This concentration is a double-edged sword. It shows strong relationships and trust, but losing even one of these giants could seriously hurt their business. They are also renegotiating agreements aiming for longer terms, with the Big Five having expiration dates ranging from 2030 to 2035. This provides some visibility into future revenue streams. Speaking of risks inherent in their business model, they're heavily exposed to cyber attacks. They collect tons of sensitive data from partners and customers alike. While they invest heavily in security, the sheer amount of data and the complexity of modern threats, including advanced AI tools used by hackers, means a breach is always a looming threat. A breach could lead to massive financial losses, regulatory fines, and severe damage to their reputation. which, as we know, once lost is incredibly hard to regain. And here is a big one for Synchrony. They are all about us consumer credit. This means they're super sensitive to economic ups and downs in the US if the economy tanks, if unemployment rises, or if interest rates skyrocket. Synchrony feels it directly. They're not diversified across different countries or massive industrial sectors like some companies. So what happens to the average American consumer's wallet directly impacts Synchrony's bottom line. Then there is regulation. As a financial institution, Synchrony and its bank subsidiary are heavily regulated. They have to meet strict capital and liquidity requirements. If they don't, it could mean serious trouble, limiting their ability to operate, pay dividends, or even grow. They are currently meeting these requirements, but the regulatory landscape is always shifting, and new rules could increase their compliance costs or simply make business harder. Looking at their core operations, the money left after covering their main costs like loan losses, and what they pay partners was $9.2 billion in 2025. This is up from $7.9 billion in 2024. The improvement here is largely thanks to that lower provision for credit losses we talked about earlier. Internally, they're constantly refining how they calculate their allowance for credit losses. The money set aside for loans they expect to go bad. They've updated their methods to be more sophisticated, analyzing things like the probability of default and how much they might lose if that happens. This is crucial because these estimates directly impact their reported profits. They're using macroeconomic forecasts like unemployment rates to help predict future losses. If those forecasts are off, their allowance could be insufficient, leading to write-downs. In their accounting, they have a section that details changes in their allowance for credit losses. At the start of 2024, it was $10.9 billion. By the end of 2025, it had decreased to $10.4 billion. This decrease is mainly attributed to lower expected losses based on current conditions and better than expected customer payments. When you look at where their loan receivables are concentrated geographically, Texas leads with 11% of their total outstanding loans, followed by California and Florida. It is a good reminder that even a company primarily serving us consumers can have significant regional concentrations. This reliance on us consumer credit is a recurring theme and a major risk factor. They're directly tied to the health of the American consumer. If people stop spending, can't pay their bills, or if new regulations make lending harder, Synchrony is on the front lines. This is why they're constantly monitoring economic indicators and adjusting their strategies. One of their key strengths, their deposit base, also comes with its own set of risks. Competition for deposits is fierce. If they can't keep attracting and retaining deposits, or if interest rates make other options more attractive to consumers, it could impact their ability to fund their operations and grow. And let's not forget about their partners. Synchrony's success is deeply intertwined with these retailers and service providers. If a partner doesn't actively promote Synchrony's credit products, or if that partner's own business struggles, it directly impacts Synchrony. It's a partnership that requires constant effort and alignment from both sides. We've touched on cyber risks, but it bears repeating. The financial world runs on trust and data. A major security breach could be catastrophic for Synchrony, not just in terms of direct financial loss, but in the erosion of that crucial trust. The report explicitly calls this out as a major business risk. Competition is another massive factor. They're not just competing with other banks, they're up against nimble fintech companies, and even the tech giants like Apple and Google who are increasingly involved in financial services. Staying ahead in this rapidly evolving landscape, especially with new technologies like AI, is a constant challenge. So what is the big picture here? Synchrony Financial had a solid, if somewhat unexciting, year in 2025. They managed to grow net earnings mainly by controlling loan losses and optimizing their funding costs. Their core lending business is stable with strong relationships with major partners, but the concentration risk is undeniable. They're making smart moves, like acquiring versatile credit and expanding their digital offerings to adapt to the changing financial landscape. However, they're also navigating significant challenges, intense competition, the constant threat of cyber attacks, and the ever-present risk that economic downturns or regulatory shifts could hit their US consumer credit focus hard. They appear to be managing their risks prudently, but the inherent nature of their business means they'll always be walking a tightrope. As long as they can maintain strong partner relationships, keep their digital offerings competitive, and avoid major cybersecurity or regulatory missteps, they should continue to be a significant player, but the potential for disruption is always there. What is your take on Synchrony's financial health and their strategy for the future? Do you think their focus on US consumer credit is a strength or a weakness? Let me know your thoughts in the comments below. If you found this breakdown helpful, Give this video a thumbs up, subscribe for more corporate explorations, and don't forget to join our Discord community linked in the description for even more in-depth discussions. Thanks for watching, and we'll see you in the next one.